special guest, Mr. Dan Morehead, is the CEO and co-chief investment officer of Pantera Capital, which is, I'm sure you know, the first investment firm focused exclusively on digital assets and blockchain tech ecosystem. Dan will present his professional view on digital assets and why it's the best time to look into them and invest into them.
Hi, this is Dan Morehead from Pantera Capital, the first firm to offer blockchain funds to institutional investors in the United States. Thank you so much for having me in Blockchain Week. Excited to be part of this incredible presentation. The topic for today is the macro case for digital assets. I'm going to start with a brief overview of what digital assets are and then why this era, that a couple of years after the economic shock from the pandemic, is probably a very important time to address them and potentially invest in digital assets. If you think back, the first instance of Bitcoin, Satoshi invented it in response to the financial crisis of 2008. The Genesis block even included a reference to the 50 billion pound bailout of British banks. Our view since March has been that Bitcoin was born in a financial crisis. It will come of age in this one. And I wanted to review the opportunity. Bitcoin is a transaction and store value breakthrough. It's really an amazing change from paper money and other forms of transactions. And then Ethereum brought about smart contracts, the ability to let the machine actually allocate money between multiple participants. So you don't need expensive middlemen holding the funds in a transaction. And then new blockchains or protocols like Polkadot are allowing interoperability, much more scaling, and should expand the usability of blockchains themselves. And it's important to know that when people are talking about digital assets, it's not just Bitcoin. Bitcoin obviously is, the most important protocol out there, and it's been around for 12 years. But as smart contracts and other protocols like Polkadot become more and more important, they're gaining a larger fraction of the market share. Bitcoin used to be almost 100%. Now it's 58%. So 42% of the market are other assets that one could invest in. And just a brief overview of those other types of use cases. You have things like Filecoin, decentralized storage network. Storage is obviously a massive business. You have huge entities like AWS that make billions and billions of dollars on it. And you can do that in a decentralized way. You don't need to pay for a centralized counterparty to do all that. Open finance is another important use case. Blockchains are allowing new ways to do business without paying very expensive central counterparties like banks. And we're seeing the explosion in DeFi right now. This is a graph of the value in decentralized finance protocols. It has been gapping up over the last 6 months. And it's still, only $11 billion. For those of us in the industry, that's fantastic. We're really excited about that, but it's a tiny, tiny fraction of the overall finance market. So it could keep growing at these kinds of rates for, maybe even a decade. The same thing with decentralized exchanges. They are, we've been investing in them for many years, and just in the last, 3 or 4 months, they really exploded in volume. There are other interesting plays like infrastructure companies. We're investing in a company called Amber that's in Asia, helping institutions execute across these, dozens and dozens of different exchanges and, hundreds of different tokens that are very difficult for normal counterparties to transact. The opportunity itself is the disruption of all of these centralized businesses like digital payments, remittance, even gold. Gold's been awesome for 5,000 years, but if you have all your wealth stored in a brick of gold that's sitting in a vault in Zurich, it's very hard to buy a cup of coffee in San Francisco with it. With blockchain, you can store all your wealth and then use it wherever you are. And in particular, even if you immigrate, all that wealth comes with you. Ultimately, though, I think blockchains will disrupt and take market share away from currencies themselves. Most people don't think much about currency, but in an era like this pandemic economic crisis, we're starting to see quite a bit of impact on currencies. With the market size of 350 billion, currently, you could easily see cryptocurrencies going up by multiples, just returns you just don't see any other asset class. One of the benefits of putting cryptocurrency in a portfolio is it's uncorrelated with all traditional assets. The problem with portfolios these days is portfolio theory has been so successful that everybody basically has the same portfolio, and all things are now correlated. So when you do have a shock, like in March, all assets go down because everyone's trying to sell some risk to get some risk off their books, and that causes all assets to be correlated, even though they shouldn't have anything to do with each other theoretically. Since most institutions don't have a meaningful exposure to Bitcoin or other blockchain assets yet, that's why they're still uncorrelated. Historically, they have a 0.08 correlation to other asset classes. And anytime you find an asset that has a 209% compound annual growth rate for the last 9 years and has zero correlation to everything else, you really should have some of that in your portfolio. And that's the biggest reason to focus on blockchain itself. So bring us to the macro case. We've been bullish on blockchain for 9 years. It's a theme that's going to take decades to play out. But right now, the macro case is as strong as it ever could be. We've seen countries, this is an exchange rate for Japan, that use printed money to prop up the prices of equities. Since Japan started doing that, the value of its currency has been plummeting relative to other currencies. And we have the Federal Reserve in the US is talking about printing literally unlimited amounts of money in order to stabilize the economy and push up the value of things like equities. And that hasn't been a pretty picture for currencies. So Bitcoin serves as a very good hedge against paper money, which is depreciating. Here's a price of paper money versus something that can't be printed, gold. But if you priced it in S&P shares or cups of coffee or median home prices, it would look the same. The value of paper currencies has essentially crashed over the last 50 years. And we're now entering a whole new world of unprecedented money printing. And so I would imagine that these graphs will continue to gap down. Here's what I alluded to at the beginning. Satoshi began Bitcoin with the very first block, the Genesis block, quoting the Times of London headline that the Chancellor had just bailed out the banks for 50 billion pounds. The United States is printing $50 billion every 4 days now. This is absolutely off the charts, and it will certainly have an impact on lots of things. But the one thing that is very clear to me is it's going to have a major impact on the value of things that cannot be quantitatively eased. And we'll see a little bit later that the impact it's already had on prices of those types of assets. This is a graph of the debt issuance in the United States since it was founded in 1776. In the month of June, the United States printed more debt than it did in the first 200 years of its existence. That has to have an impact. And again, there's been an unprecedented use of the word unprecedented in the last 6 months. These pictures just put it all visually. This is just got to have an impact on other things. And lastly, wanted to show the Fed has now promised to double inflation. That is an amazing turn of events. I spent my whole career having the Federal Reserve and developed central banks fighting inflation, and now they're promising to increase it. And the one thing we've learned is that fighting inflation is very difficult. There's 200 countries on earth, and the majority of them really have not been successful in fighting inflation. It takes commitment, it takes institutional buy-in, engagement, it takes decades to do. However, the one thing we know is when central banks want to create inflation, it is very easy to be successful. You have Zimbabwe and Venezuela on the leaderboard now with inflation. If the Fed tries to double inflation, it certainly will be successful. They are saying they want to keep it an inflation average above 2% for a multi-year period of time. This is a forecast from Wall Street of all the major economies showing inflation either negative or around 1%. So in order to average 2% over the next several years, they're going to have to run it at 3 or 4% for quite some time to get it to average out at 2. That is the equal and opposite reaction has already been seen. Here's a list of the year-to-date changes in the price of major asset classes. Oil, real estate, commodities all way down. Stocks are up, and that is, in my mind, the best proof of the macro case for blockchain. Is stocks obviously are disadvantaged by an economic crisis. The current estimate for S&P earnings for this year is down 30% from the prior year. When stocks are down when earnings are down 30%, all things being equal, you'd imagine that the price of equities would be down some commensurate amount. Stocks are actually up, which is proving that there's so much paper money in the system floating around that it's floating all boats, including ones that are impaired by the economic crisis. Then you have things like gold, which are kind of neutral to the economic crisis. They're at record highs. Gold's up 26% year to date. And then blockchain assets are not only not impaired or neutral, they're actually positively advantaged by the changes that are being wrought by this economic crisis. And we'll go into that a bit later. And you can see that reflected in the prices. Bitcoin itself's up 49%. My partner Joey Krug's Augur project's up 56. And then other things like decentralized exchange 0x up 100 and Ethereum up almost double that. So the case is being proven out already. I think we have another couple of years of this. On the macro side. On the fundamental side, it's still very strong. This is a graphic that attempts to get information from private companies, which is often very hard for investors to get at, and aggregate that across our portfolio. We're invested in quite a number of companies that help people use Bitcoin or other blockchains to send money around the world. And this is a normalized aggregation of 6 of them. And since the crisis began, the volumes have exploded up, more than doubling. And that adds to the macro case to be using cryptocurrency or investing in cryptocurrency now. Another development is you have a handful of large companies actively putting Bitcoin on their balance sheets. This is, obviously a huge credentialization for the blockchain space. And it's typically been shown to more than be valued into the company's stock price when they've done that. Here's a couple of market perspectives. The question is always, is the halving is the halving important to the currency, and where are we in the cycle of cryptocurrency prices? And here we use Bitcoin as a proxy for the industry. Obviously, it's only 2/3 of the industry, and there's many other really interesting assets, but it's been around the longest. This is a graph of the price of Bitcoin since it began trading in 2010, and it's done as a log graph because obviously any disruptive technology has a very hockey stick looking graph, like Apple or Tesla or whatever. In order to see its real changes over time, this is graphing it in a log basis. And it shows it's actually relatively steady. It really does grind up about 200% a year. Obviously it has some manic bubbles, and then it has some 60 to 80% downdrafts. We're still 50% below the highs. So, even with all this incredible global macro backdrop, we're still at a price point that's still reasonable. For example, gold, if you bought into that story, you'd have to be buying it at a 5,000-year high. Here, you're actually buying it halfway below its normal high. Also, the number of Bitcoin that are issued to the market gets cut in half every 4 years. That happened this year, and historically, that's had a very strong impact on the market. So we're quite bullish. We think another year or two of this rally is likely to ensue. And then, lastly, thinking about, is it just Bitcoin, or should you have exposure to other cryptocurrencies? This is a graph that shows Bitcoin against, essentially the mid-cap cryptos, the things that are smaller and, typically in smart contract space. They've done quite a bit better than Bitcoin. We're wildly bullish on Bitcoin. We think Bitcoin's going to do very well over the next, several years, but we actually believe that other tokens will do even better than Bitcoin. Said another way, that the ratio of Bitcoin as the total percent of the market will be going down over time. And with that, I wanted to thank you for inviting me to speak at your conference. And if you have any questions or information you'd like, feel free to direct it to our investor relations group, ir@panteracapital.com. Thank you.